Welcome to our Market Narrative series. I'm Julia Newbold, Managing Editor at Connexus Financial. Today I'm talking to Alex Khosla, Portfolio Manager in the Emerging Markets and Asia Equities team at Newton Investment Management. Newton Investment Management uses active, thematic and engaged investment to deliver attractive outcomes to clients and to help foster a healthy and vibrant world. Thanks so much for joining me today, Alex.
Thanks very much for having me.
Now, volatility has been a theme of 2022 as markets and economies continue to be influenced by COVID, energy transition, wars and inflation. With this backdrop, emerging markets has been a bridge too far for many investors, but Newton and yourself suggest that it could be a good place. So, Alex, while many investors are looking to de-risk their portfolios right now, why do you believe emerging markets might be a good place to invest?
Sure. So I guess we think that it can pay in moments like right now to take a step back and keep thinking both long term and quite simply. So what are we talking about when we talk about emerging markets? It's a heterogeneous, almost dazzlingly heterogeneous group of countries where about 4 in every 5 people on the planet live today. An even higher proportion of the world's young population live in these countries, and they account for about 50% of global GDP. All of that is serviced by about 10% of equity allocations in the world today. And we think that's a pretty stark disparity. We also think Newton's a place where sustainable investment's very core to what we do. And when you're thinking about investing sustainably, what makes it even more striking is that 2/3 of the world's investment needs for a sustainable future, according to the UN, need to happen in developing countries. And again, there's this huge disparity between where investment is most needed, and again, equity allocation is a little over 10%. Even when we look at sustainability funds today, there's a recent report saying that close to 90% of them are either global or developed market sustainability funds, and again, we really think that the emerging markets is somewhere where capital is scarce versus its need.
And how do you go about choosing where to invest?
So we like to start bottom up. We like looking at companies. The way that we choose which companies we think are really providing solutions to those sustainability problems I highlighted the world is facing is we like to ask 3 questions about those companies. The first is the context of what need the company is addressing. The second is whether the company is around additionality, so whether the company is really providing a new or innovative solution to that problem. And the third is management purpose. So we try to identify whether we're in a company where you can feel alignment, integrity, and competence of the people running it, and where the people running it will keep that company focused on those needs that I was talking about before. Obviously, even though we start bottom up, you can hear for other questions that we want to ask. The regions and the industries that a company operate in is quite important. For context, we think that companies that are looking to solve environmental problems, or companies that are looking to solve healthcare problems, even companies that are looking to solve problems of financial underpenetration, those are ones where the industry starts to matter, and also where the country starts to matter. To be very basic, a company selling insecticide in India is obviously going to be one set against a better context. Again, with additionality, it starts to get more about whether a company is reinvesting its capital in a way that either lowers pricing to consumers or provides a particularly innovative solution, or reaches a new group. So you can see quite quickly how things like regions, things like industries, things like management that are traditional things that people look at when they invest start to play into that framework.
Alex, is it more difficult when you're looking at emerging markets to separate the wheat from the chaff?
Yeah, I think it really can be. I think that we one of the things that often gets highlighted to us or asked of us when we're talking about sustainability investing in emerging markets is how do you know? You know, how can you be sure how when there's limited data or limited reporting, how can you really differentiate between companies? I think that we think that there's a few answers to that question. One is to those more holistic questions that I was asking about what the company does, whether it does it in a way that's additional to the problem and or solves the problem, as it were, and whether management's aligned. We think that's one way of doing it. But the second thing I'd point out is that when we do think there's enough data now to start, as long as you work hard and you keep plugging away, to start really trying to track company progress on whether they're delivering versus those sustainability goals. The final thing I'd say is a tool that we use in as you said, a difficult environment is engagement. So active engagement on sustainability issues in emerging markets can help drive companies in a positive direction, just because emerging market companies are not inundated with RI analysts making requests. As I said, it's a under penetrated part of the market, so you can, with small soft touches, start to make big changes. And even if you can't, what you can start to do is analyze those companies by their responses to what you're doing. So yeah, it's not necessarily easy, but we think that there's growing data available. You just have to keep plugging away, and through tools like engagement, we have a fantastic engagement and sustainability team here at Newton, and they really help us understand how companies are responding to these issues, even if they don't necessarily have all of the data as perfectly laid out as you might find elsewhere in the world.
And as things change in the markets, is there a need to stay disciplined in this type of investment to really reap the rewards?
Yes, I think that there is. I think that you need to. What do you mean by as things change? Is it necessary to stay disciplined?
I guess as countries change and the wars happen, and different countries might become ruled by different political factions, do you keep disciplined in the companies that you're investing in, or is that all something that you're going to be thinking about maybe moving or paying extra consideration to?
Sure. So I think that there's two ways of looking at it. The first is that, like you pointed out, we're investing across a wide range of geopolitical or institutional backdrops. And the first is to try and get some sense of where those institutions are weakest that might present some of those risks that you talk about. As it happens, where those institutions are weakest, it often feeds into the bottom-up analysis as well, because where you have weak institutions that can result in things like kleptocracy and things like war, they're often not great environments for businesses that are looking to try and sustainably solve unaddressed needs in a society. Those sorts of environments tend to lend themselves better towards businesses that are rent-seeking or are more sort of kleptocratic by nature. So on the one hand, we think that to some extent the bottom-up process helps you avoid those sorts of areas and keeps you disciplined away from them. On the other hand, as you said, you sort of have to remain humble in your own ability to be proven wrong over these things, particularly as a bottom-up investor. And for that reason, being at an institution that's well resourced, like Newton, is a real privilege. We've got geopolitical teams that keep us abreast of where these risks are really starting to flare up, as well as teams that invest in different asset classes. So have views that are more macroeconomic in nature. So yeah, I think it's a combination of both.
So to just explain again, you look at the companies first and then the industries they're working in, and then you'll overlay that with the geopolitical information that you have.
I think that's a fair summary. Yeah. I think that we really like to start at a company level, but obviously the industry and the region where a company, and none of these companies operates in isolation. So the industry in a region that a company operates in is always going to affect its ability to be a real solution provider in the way that we want.
And you said earlier that you had a 3-bucket strategy for when you're investing in a company. Can you explain that for us?
So the company that we try to ask quite holistic questions around the context of an under-addressed need in emerging markets, the company's additionality, so whether the company is really providing a solution to that context, and management purpose. So I'll dive into each three. In context, what we're trying to understand is the severity of the issue being addressed, and we try to gauge, whether foods versus medicines versus travel, and whether some needs are sort of more pressing than others. We look at the regional context, so whether there's certain parts of the world where there's huge problems with mortality or healthcare. There are some parts of the world where there are problems with financial underpenetration, and even within emerging markets, there are big variations between those under-addressed needs. So we try to keep in mind the regional context. And then the third thing with context that we try to understand is around negative externalities. So an example of that would be in lithium extraction, are the water intensity and biodiversity risks implied by lithium acceptable for the benefits derived from the lithium itself? Or in hydropower, are some of the environmental negative externalities acceptable for some of the positive externalities of cheaper and more renewable power? So a deep, nuanced understanding of those contexts can equip us to best identify the most secure avenues for sustainable growth in emerging markets. But once you've understood that context, you then need to try and understand whether and you move to the second bucket of whether the company is actually providing a better solution to that context. So you can't just say it sits in a specific industry or specific country. You have to actually identify whether the company provides a better solution. So to that, you again need to start digging around some important questions, such as, are the company's products and services just better than or less expensive than alternatives? Is the company reaching underserved customers, maybe by enhanced distribution or progressive pricing? Is a company involved in establishing industry-leading research and development, so new solutions or enhanced existing ones? And to the point around that I mentioned in the first one, in context around negative externalities, when you look at company additionality, you can start to try and identify if a company is leading or lagging its industry in addressing some of those negative externalities. So the interesting thing about the second bucket in company additionality is that it starts to point us as sustainability investors to those companies where both durable growth and also sustainable competitive advantages are being built. It starts to link us towards what traditional investors might call moats around a business. Because if you can find companies that are really providing additionality, you are starting to identify why a company might generate excess returns as well as growing along with these industries. The third bucket that I talked about was management purpose. And here we're trying to find alignment, integrity, and competence of people at the company, particularly the owners and senior leadership of the company. This is important for a number of things, but firstly, to make sure that the business stays trained on that sustainable growth opportunity that I talked about before. But the second reason, the second reason is to that good owners and good managers often nurture and replenish the franchise strength in that company additionality that I talked about before. By driving good capital allocation or driving good corporate culture, all of these things feed into that company additionality. And then finally, good managers tend to bring minority shareholders along for the ride without ripping off other stakeholders. And bad managers often do the opposite. Assessing management purpose is very hard and it's very qualitative, but we do think it's critical along with all three of these buckets. And we also think why it's important to have a team of investors that are trained or have different backgrounds, trained across a wide degree of sort of skill sets, because some of these more qualitative things are difficult for investors trained to build spreadsheets. Equally, some of the more quantitative things would be difficult to come to terms with if you just had people that wanted to look at people.
Alex, do you have?
And the final thing I'd say, sorry, you go. No, you go.
Do you have any examples of where being closer to the management of a company has turned you off that company, and everything else has been pointing towards it being a great investment, but you found out something that you thought, can't go there?
Yeah, I think I'm not sure I'm allowed to mention individual businesses, but I can perhaps give examples both ways. There's so the solar industry is one that's going to be immensely important for renewable energy, and the cost profile of solar is making it incredibly exciting for people that are interested in a renewable future. But one of the things that we often find in solar companies is that we find it difficult to find companies who are really committed to innovating down the cost curve. Some companies are just there to empire build, and some companies are more interested in scale for scale's sake, rather than really identifying where they can improve the industry's cost profile by doing specific things around innovation. There's a specific solar company that was founded by 4 university students who came up with a new way of developing wafers within solar cells. And they went to every solar company in the industry and said, hey, we have this new technology. And every solar company in the industry said, no, we're not interested, because they were sort of so invested in their own technology. And these four students, they were students, set up their own business and dedicated themselves to sort of innovating to try and lower the cost of that specific part of the solar chain. And as a result, and because of the culture that they've built, they've managed to today build one of the more successful solar firms. It's a firm we really like and really can get behind, because we can identify how the management have built a franchise that really seeks to solve for a problem, rather than just sort of hoping that if they allocate capital to this area, they'll grow. And we think that's a more sort of defensible position in an exciting industry. In terms of ones on the other side, where you have businesses that might be set against a good industry backdrop and may even sometimes provide bits of additionality in terms of providing solutions. There are heaps of examples, and there are some pretty big ones in emerging markets where the revenue mapping of the company might work well, but where the owners or the management of that company really found themselves in that industry because of some sort of patronage or some sort of link to a government that wasn't because of their competence, it was because of other things. And we tend to believe that in the very long run, those businesses are more likely to be found out. And as a result, we find it harder to commit capital to them on behalf of our clients for the long term. I won't go into any examples too specifically, but maybe one for another time.
Thank you for that. Are there any particular regions that you would avoid investing in?
Yeah, so I think it speaks to the point you raised earlier about geopolitics. The way that we like to think about regions is is really around the institutional strength of those environments. And there are certain countries where the institutions have developed in such a way that they don't really incentivize people to innovate and then reinvest in that innovation. They don't really incentivize companies to address some of the problems that society faces. Instead, they incentivize rent seeking, or they incentivize sort of knowing the right person in order to get what you can out of a particular economy. For that reason, we found it difficult to invest in places like Nigeria, which, even though it has a very large population that have a lot of underserved needs, we found it difficult, given the institutional backdrop and the macroeconomic backdrop, to find businesses that tick all three boxes for us bottom up. And our macroeconomic teams make it clear to us that also feeds through to the macro side of things. There are a few other examples in emerging markets where that proves difficult to. But I'll stop there. I think you probably get the idea.
Can you explain your investment methodology for us, your stock picking and your attention to ESG investing? How do you know you're getting the right information for the companies that you're looking at?
Sure. So I think that I think I spoke to this a little bit earlier, but one of the key criticisms of sustainability investing is that there's not enough data available to really know if the outcome you're hoping for is coming true. What we would say to that is that we think actually once you get to grips with it, firstly, that data is improving. India and China now actually report, the majority of the companies do some sort of sustainability reporting. The quality is varied, but there's steps being made in the right direction. And often not just in that sustainability reporting, but if you really dig and you have the resources, we're very lucky at Newton to have a very large and very effective RI team. If you have the resources, you can start to dig around in company disclosure for bits of data and bits of information that can either corroborate or disprove what you're looking for, be that how much installed capacity you have as a solar company, or the microloans that you're giving out as a financial company, and crucially what interest rate you're making people pay on those loans. The number of if you're a hospital, the number of chemotherapy cycles you perform. Some certain hospitals report that. So there are a number of different ways that, even though they might not be all-encompassing and perfect pieces of information, you can get these fragments of data that you, as long as you're well-resourced enough, can start to piece together pictures on whether companies are moving in the right direction. So in terms of our ESG process, we have a large and now fairly detailed spreadsheet that we use both to inform ourselves and also to inform our interactions with the company as we sort of keep plugging away at trying to figure out if we had the right idea.
Alex, can you give us a bit about your own history? How long have you been working in the emerging markets area, and what are the trends that you've seen during that time?
Sure. So I've been doing this about 10 years, so I'm still pretty early in my journey. But it's been in a space that's really growing, and it's been a fantastically interesting time to be here. In terms of trends or what's changing, I think early sustainability investing was often more aligned with sort of starting to put companies in boxes and arguably simply box ticking. So you had companies that would maybe find their way into sustainability funds simply because they just got there first on disclosure, or they got there first on certain metrics like carbon emissions or demographic ratios in their management teams or their ownership. I think that, I'm thinking of a particular example there that made it. There was one company in Latin America that made its way to the top of this is years ago now, it's 7 or 8 years ago, but it was a very successful company that made its way to the top of every sustainability-oriented fund in Latin America, and it was because it ticked a lot of those boxes I was talking about. But the way that they made their money and the way they made profits was driven by a cozy relationship with their specific regulator. And that specific relationship with the regulator broke down, again, without naming the company. As soon as that relationship broke down, so did the profitability and the growth profile of the company. And it did badly as an investment. And I remember going around Latin America fairly early in my career, and people using it as an example of why sustainability investing didn't work. And I remember thinking I didn't think that it was an argument against sustainability investing itself. I think it was just an argument about how by simplifying sustainability too much into certain metrics or certain ratios, and not thinking holistically about businesses, that actually you can get dragged into companies that don't really fit what we really are thinking about when we try to identify companies that are addressing some of the sustainability problems that the world faces today. That was an incredibly long sentence. Sorry. But,
and Alex,
hopefully I got the message across.
In your time in the emerging markets area, are there different regions that people have favoured? Is there more focus on one thing than another that you've found?
Yeah, I think regions have come and gone out of favour. So I think sometimes that's just to do with the vagaries of the market, but other times it's to do with real improvement or real deterioration in the institutions or the backdrop of a specific country. There are sort of fairly non-controversial headline examples of that. Almost my entire career, Russia's been headed in that direction, as we've sadly seen sort of epitomized in the last couple of years. But Russia had been heading in that direction for some time. If you looked at the sort of political and institutional backdrop there. Similarly, India, which is almost coming from the other direction of somewhere that had consistently sort of under delivered versus investors' expectations of what it could do. You're starting to see improvements in the business environment there. I'm not a macroeconomic expert, and I wouldn't claim to understand in a lot of detail how these regions are sort of truly evolving. But at a headline, it's certainly been a space as an investor where you've seen large changes. And it's the reason why I think it's probably been, I'm still early in my career, but it's probably been a great training ground to see a number of cycles quite quickly, which I think are probably is probably a good way to learn as you're making your way in this investing world of ours.
Alex, is there a greater need for more active management in this space, in the emerging market space?
Yeah, absolutely. I think I think a lot of what I've been talking about highlights that I really believe you used the phrase sorting the wheat from the chaff, but I really think that's important in developing countries. There are these huge unaddressed needs, and there are entrepreneurs and owners and businesses that are really seeking to address those needs. But there's also huge parts of what you would invest in if you were a passive investor in emerging markets index that don't get close to actually achieving that. As a result, as an active management's really important, because you want to be aligning yourself with those few opportunities that have really great amplitude and possibilities, and avoiding large swathes of the index where they don't necessarily fit into those categories that I talked about before in terms of being against a big growth backdrop. having a company that's really trying to provide a solution and being aligned with a management team or an owner.
And Alex, we've talked about this before, but when you're looking at a company from an ESG perspective, how important is the E, the S, and the G? How do you look at them all combined?
Yeah, so I guess the first point to make is that we probably don't look at it through a lens where we divide them up that neatly. Like I said, we're trying to stick to this philosophy that we built and this process that we built that is really, really geared towards solutions providers. And some of those solutions are environmental, but some of those solutions are geared around health. And some of those solutions, we like to say earth, health, and wealth. Some of those solutions are environmental, some of those solutions are geared around health, and some of them are geared around wealth and financial inclusion. To give you some, there's a billion people that are unbanked in the world. They're all in emerging markets, and I think that there's our key target is not just environmental, but it is these other underserved needs. So environmental is one part of that where we sort of are hunting. And then in terms of social, really that comes out in, I mentioned the negative externalities and the stakeholder bit. That's something that starts to work its way in as we start to go bottom up company by company. Once you're in a growth opportunity and looking at a company, you then start to think about how that company interacts with the social environment. And then governance really comes, in that last bucket that I talked about, where we want to see a company that is reinvesting in trying to provide that solution, address that specific need. But we also want to see a company that's aligned with us as foreign minorities, trying to bring capital to that opportunity.
Thank you very much for everything today, Alex. It's been a fascinating discussion and an exciting place to be, I guess, right now.
No, yeah, I really think so. No, thank you very much for giving me the time, and hope to talk again soon.
Thank you very much. You've been listening to Alex
Cheers.
Khosla from Newton Investment Management. Thank you.